So moved.
Second.
All in favor? Hands up, I guess. All right. Any opposition? Motion's passed. Rick, do you want to go through health claims then?
I will, yep. I'm just sending something to Chris real quick. Hold on one sec, sorry. All right, so we sent you the information through the first half of the fiscal year. And as you can see at the bottom, we're trending very well right now, as our claims overall are down this fiscal year compared to last fiscal year at 3.6%. We are compiling January data right now, and weren't able to get an update out to you, but we've have since dropped to 4.6%. So we're continuing through the month of January as we did for the first 6 months of the fiscal year. So outstanding news. We're working on our budget right now, and we'll be presenting the budget to the town council on next Tuesday, the 9th. And we would be presenting our budget to the risk board at the following meeting as well. And I can't share anything with you until it's shared with the town council, but overall, it's certainly really good news from a risk management perspective overall. So our risk budget is going to come in pretty strong for the upcoming fiscal year as well overall. So I'll share that kind of anecdotal information with the board. And outside of that, I think, in the last meeting, we talked about some of the union negotiations that are going on, and they still are. We have a couple of, we have 7 tentative agreements that we're working on language right now, but we do have agreements that, without getting into too much detail, will spin positively for our risk budget as well. So, but again, I can't get into too much of that in this setting.
Rick, it's Kathy.
Yep.
Is it possible for you to show the claims on a per member per month basis? I don't know that there's much shifting in personnel, but to the extent
We can.
you have,
Yep, we can add that to this exhibit. And there hasn't been much of a shift at all
okay, good.
from last year to this year in terms of overall personnel. So it's not attributable to a drop in
Okay.
covered personnel.
Okay, good.
And whether it's related to the pandemic and folks not actively, going to the doctor as much as they may have in the past, I don't know that. I know our dental claims are down for that reason, as they are across the country, but I'm not sure we can attribute health claims to that.
In terms of my past experience, I would expect them to be down for similar reason, that even when you have a heavy flu season, you tend to see a depression in other claim costs, partly because the people more susceptible to flus, et cetera, are the same people that have underlying health conditions and would need other types of care. And then also, since people don't want to be exposed with this, especially during a pandemic, you tend to have a reduction in any kind of discretionary items, knees and hips and that kind of stuff. So it would be super surprising to me if you hadn't seen a reduction. Exactly how much is really hard to predict, but I would expect to see this kind of drop. And some people expect that means that you would see an increase afterwards, but that's not what we had ever seen historically, because afterwards it kind of flows back to the normal levels. There isn't typically enough capacity to do, twice as many knees and twice as many hips and hearts and all that kind of stuff. So it doesn't tend to, you tend to have a drop that isn't then made up for on the other side when you have something like this.
Right.
It seems on the health claims, looking at the 12-month rolling average, as though the real anomaly in data was the 11 or so months leading up to the June 20 rolling average. The June 20 was a huge period, and December 20 is getting back towards a softer line that seemed to have been in place for the prior couple of years. It seems as though
drop it back to those.
But you would expect the underlying trend to be going up. The costs keep going up. So
right,
the
but
fact that
not at
it's not,
6.8% like June was, and now it looks like maybe
yeah,
we're
but
back to 2% or so.
yeah, but I would argue that that's just then there isn't enough membership and that you're seeing some volatility in there as opposed to the underlying trend costs. But
Well, that 3.6% decrease is certainly softening out the 6.8% increase from June. And going back to June of 19, that looks like a logical trend, about 2% a year, maybe.
that looks really low to me.
It is low, yeah. We should be, Kathy's right, we should be in that 7% range.
Well, 19 and 18 year were outperformers also.
Yeah. So, but that's why it's helpful to look at it on a per member per month. It's hard to see. I don't know if there were any benefit changes, but it's hard to see whether there was something else going on there. You wouldn't have expected that kind of flatness in that curve, but the down right now I would expect. So anyway.
We are tracking, it's not in this document here, but we do track on a monthly basis our COVID-related healthcare costs on the town. So we're not able to track it on the state partnership plan specifically to COVID. But on the town to date, we've spent $75,000 on COVID-related healthcare costs, trending back or going back to March of 2020.
Anything on the workers' comp side for COVID?
So we've Lisa would be able to answer that more specifically. We've had claims filed, Jeff, but not sure we've got, anything's been approved.
Mm-hmm.
So we've had a number of claims filed on the town side, and then we've had one filed on the school side as well.
Mm-hmm.
But everything's been covered through our health plan to date. So nothing's been approved and paid for through workers' compensation.
Well, Connecticut only had a short time period where they were basically approving COVID claims under workers' comp from like April or so through June. So there wasn't a long time period.
Yeah.
Any other questions, observations on the health report?
Is part of the ongoing negotiations right now related to how much the employees have to contribute versus the town and that kind of stuff as well on the expense side?
Exactly. Yeah. So
Okay.
Two things are being negotiated or have been negotiated, and they are plan design and the amount that employees contribute towards the cost. So there's been two things that have been negotiated.
Mm-hmm.
If we were on site and in our normal meeting room, I'd share more details, but in this setting, it's difficult.
Mm-hmm.
Okay.
Rick, can you just remind me when you switched into that state program?
We moved the Board of Education into the state partnership plan in July of 2019.
Okay.
Yeah, and our first renewal last year, so we are in the second year of that plan on the school side. Our first renewal, we had a 0.5% increase. And this renewal, which is coming up for July 1st of 21, we are being told preliminary that our renewal for active employees will be a 0% increase for July 1st, which is good news.
And you can see them. How about a 3% decrease?
I know. Yeah. So this decrease that you're seeing on this report is mostly attributable to the town, not to the schools.
Yep. Gotcha.
Yeah. So the schools, even though we're technically, and we talked about this a couple weeks ago when we had our meeting.
Right.
It's technically self-insured, but we pay a fixed cost to the state every month.
And that's included in here as claim
It is.
costs? Yeah.
Yep.
So that's going to also stabilize your trend.
Yeah.
You might, I don't know, you must look at it separately as well.
We do. Yeah, we have it completely broken out. Yeah.
Good. All right.
Any other discussion?
Nope.
Chris, welcome. You made it.
Oh, we made it.
Thank you. Good to see everyone.
Good to see you. I thought you were celebrating a wonderful day in the stock market, maybe.
It's been a little bit more bouncy, as folks know, but we do have some results for the fund through the end of the calendar year, and happy to share those with folks. I don't know protocols or preferences from the committee. Do we want to try to share the report, or does everyone have kind of ready access to it? Any preferences?
I have access.
Yeah, if you could share it, Chris, that would be great.
Okay.
Yeah, I don't think I've seen it at all. Has that been sent around?
Let's see here.
Yeah, I don't know if Peter shared it with the group, Chris. We may not have it.
Bear with me here. Just a second. I seem to be. What do we want to do? What's going on back here? So I don't know why I'm having, let's try this. Bear with me, folks. For some reason, it's not letting me. Let's see if this works. Give me 2 seconds here. I don't know why I'm having trouble with this tonight, but
You're not the only one.
let's see if I can do it this way. Oh, can folks see that?
Yes.
Everyone can see the screen, West Hartford Retiree Medical Fund. Great. So let's, we'll hit the highlights for you. I know you've got other things on the agenda, but great again seeing everyone this evening, and trust everyone is well. I started at midnight last night, and I finally procured my first vaccination shot at 9 o'clock this morning. It's not till May 5th now, so. But otherwise, anyways, let's we'll cut to the chase here for folks just quickly, because I think it's been a little bit of time. I know we've talked certainly since our merger, but just to bring the group up quickly, to date, we are essentially fully integrated with our partners in Chicago at DeMayo Schneider, and kind of fully operating and firing as a single firm, and doing that with a national footprint now. And I think, as you know, just in terms of the type of services that we render, it runs across a variety of fiduciary frameworks, if you will, retirement plans, endowments, foundations, and the like, and somewhere's on the order of $200 billion of assets nationally that we consult to. And throughout the pandemic, continuing to hire and staff accordingly for growth and to maintain our service standards for existing clients, and some fairly high level hires, as you can see there. Julie joining us as Chief Operating Officer, Monica joined us as CFO, and a host of other hires. So really on all fronts, kind of integrated in a manner that I would suggest maybe even more rapidly than we would have absent the pandemic, if you can believe it, just because we're not in cars and on planes and the like traveling. So we're in good shape from a merger standpoint. I'll set aside the accolades for you for your consumption elsewhere. And then just quickly, just to give you a touch of context before we look at the portfolio. You see here on the page a representation of equity returns, global equity returns for the fourth quarter. And as you all know, a generally upward trend there. and really indicative of the amount of appetite for risks that has remained in markets since the throes of the pandemic back in March of 2020, and the motivations or backdrop for that, as I think everyone appreciates, are two or threefold. Certainly, all of the stimulus in the system, both in terms of monetary stimulus and liquidity programs from the Fed, and joined by fiscal stimulus, and it looks like some more to come, have all given investors a good deal of comfort, of course. And now that it's starting to marry, hopefully, to a ramp up on the vaccination front, certainly the discounting mechanism that is markets is pulling some of those returns into the present here, with an expectation that the world will start to open up and grow in an accelerated manner in the back half, perhaps, of 2021 into 2022. So we
Hey,
will
Chris,
go.
could you
Sure.
make the screen a little bigger?
Let's see here. Sure. Let me see if I can do it.
Either by going full screen or yeah, just making that a little bigger.
Is that Ian? How's that?
That's a little better. Yeah, it's still a little hard to read, but and do we normally get this ahead of time, or did I miss it, or was it did not send out?
Yeah, I know. I thought Lisa usually sent it out with the agenda, but I could be wrong on that this quarter. We do, Ian, typically try to get it out several days in advance, so we'll certainly use it as a guidepost going forward. But you do see here, right, a pretty, we will go through all these numbers for sure, but you do see here the general takeaway. Look at the quarter, for example, the column and data to the left there, and really a pretty broadly performing market, right, both in the fixed income and the equity arenas. And we'll unpeel some of this detail in just a minute for you to give you a little bit of a deeper dive. But certainly the makings of a splendid quarter. On the macroeconomic front, right, some of what's informing the thoughts around perhaps the emergence of a new cycle of economic growth in the back half of the year 2022 just centers on some of the underpinnings here on the data front, and you see purchasing manager composites in the upper left-hand corner of the page, and certainly those numbers swooned back in March of last year, but you do see the kind of the repair there in those figures really around the globe, and now at levels that suggest a positive trajectory in a recovering economy. And you see that in forecasts as well, right? In the exhibit here to the upper right-hand corner of the page, we had the contraction in economic activity in 2020, of course, and then expectations in 2021, 2022 for better outcomes on that front. Some recent talk about inflation, right? And does all this stimulus ultimately unleash inflation? And can the Fed stay in front of it? And certainly on the surface now, inflation remains pretty well behaved, as you can see from some of the statistics in the exhibit here in the lower left. And we don't have a mindset that inflation will be an immediate concern, although we're mindful of it and monitoring it on an intermediate basis. And we'll, of course, keep the committee apprised. And then you all know, right, the amount of stimulus that we've already kind of talked about that's flooded into the system from the world's major central banks. So that probably is a nice visual, but probably old hat for this group. Valuations on the equity market, domestic equities, as we know, have been particularly strong performers, at least until the fourth quarter, on a relative basis to international, and their valuations reflect that, right? So no surprise here. International valuations are a little bit more modest than their domestic counterparts. Probably the most interesting thing in the equity markets for the quarter, something we're mindful of, and I'll kind of tie it into why we think it's of interest to you folks, is the exhibit here on the bottom of the page. And you'll all know out of March last year, you'll remember that when the markets began to get their bearings again, that most of the interest from investors was in the so-called stay-at-home stocks, right? Those big glamour tech names like Amazon and Facebook and Netflix kind of led the charge out of the crisis. In the fourth quarter, It's interesting. You'll see here that smaller cap names around the world and value as a style around the world outpaced kind of their counterparts in terms of large caps and growth, respectively. That's of interest of us. That's continued to an extent into the new calendar year. That's of interest to us because oftentimes, historically, these type of rotations into broader, more broadly performing markets have been at the advent of new economic regimes. So we'll see how this plays out, right? But certainly, if history is true to form, oftentimes this type of pattern has foreshadowed a ramp up in economic activity and perhaps again the start of that new growth cycle. So kind of an interesting flash there in the fourth quarter on a relative basis of what worked best. And we'll see a moment in the portfolio how that kind of panned out. Interest rates have drifted a touch higher very recently, but as you know, still all things considered in the upper left-hand corner of the page here, base rates still remain pretty darn low, right? A little bit of a gap out in the quarter, but nothing dramatic. And that certainly tethers and informs, right, on a go-forward basis, expectations for fixed income. The broad investment grade market today is yielding something like, call it 1.25%. And that gives you, a decent guidepost going forward of total return opportunities and fixed income being somewhat muted. And we're certainly mindful of that. And you see here spreads or incremental yields for non-treasury securities remain pretty tight and well behaved also, and kind of marching down in a pretty pronounced fashion from that big gap out in spreads back in kind of the throes of last March. I am going in the interest, there's some other data and patterns and information here. I'm in the interest of time going to jump to the portfolio. Let me give you a couple of data points and then we can pause. Certainly take all the questions that you may have. So the portfolio at the end of the calendar year expressed here in the about $26.5 million of invested assets. You'll all remember that we're kind of governed by and some of the state statute and portfolio to 50% equity, 50% fixed income. And you see that the portfolio is fairly close to those markings and guideposts at the end of the calendar year. We actually worked with Peter by virtue of how strong the performance was coming into the end of the calendar year. The portfolio was a couple percentage points overweight equity. And we did work with Peter. We redeployed about $2 million from equities back to fixed income just to square up the target weights as we came into the new calendar year. So trying to lock in some of those gains that had accrued in the portfolio by virtue of the very strong equity results. The lineup from our standpoint, kind of top to bottom from a research perspective, we do have all the managers on maintain. And you'll remember that kind of indicative in our world that they're kind of performing in position consistent with expectations. So we don't have any issues to raise with the committee in terms of portfolio construction or allocation this evening. And then a final data point here, and then I'll pause. The portfolio enjoy a pretty strong quarter and year, as you can see here. So in the fourth quarter alone, the portfolio gained close to 9% net of the manager fees and outperformed the benchmark and gained about $2.2 million, you see in the upper left-hand corner of the page of investment gain, and ran off a pretty darn strong calendar year as well. So would have been hard-pressed to think that we would have sat here a year ago, given everything going on and the onset of a pandemic, and think that the portfolio would run off a close to 16% return, but indeed it did. And you can see some nice absolute performance and pretty solid incremental results as well. And the longer-term track record, as you see, starting to kind of press into that very consistent incremental return across most time frames. So I think we are pleased with the way things kind of played out in the quarter and moreover in the year. Some of this incremental performance was by virtue of a little bit of a tilt into equity at different periods during the year. But you've also, if you were to look through the individual managers, bear with me here. Let me see where we can. That. Is it, it was up here. Maybe not. I'm trying to remember where we put for 2 seconds. So we've been, oh, I guess we do. It's my fault. Here we go. So you'll start to see at the individual manager level, right? The managers are pretty much up and down the portfolio where you've got active management, where sources of incremental return are close to it for the calendar year. So I think we're in pretty good working order from a portfolio perspective and an allocation standpoint. And let me pause there. I'll just scroll back so we've got the visual of the portfolio and see what questions the group may have. Anything from the committee that I missed or glossed over you'd like to hear more about?
Can you slide back to the active managers, Chris?
Yeah.
The exits or their performance?
Sure.
Are the numbers in parentheses there their rankings?
I'm sorry, Jeff?
Are the numbers in the parentheses on that exhibit the rankings of the?
Yeah, those are rankings within a peer group, right?
Yeah.
So I'll jump back to it so people can see it. Yeah, so these are the rankings within peer groups, right? So I think everyone knows how to read this. I'll pick a number or two, right? Longfellow for the year was up in line with the benchmark net of fees, as you see there, 7.9%, ranked at the 41st percentile, so a touch above the median outcome for managers running that style. You work your way down the page, right? Indexing is indexing, I suppose, but you see over the longer term, right? Your Vanguard index, we've talked about it a million times, right? In large cap domestic equities, you can own that return stream for a handful of basis points, and it's ranked very competitively, indexing versus active. And that's why, we think it makes sense to index there. We moved down into Neuberger Berman, the small cap manager. Some challenges more recently on a relative basis, certainly longer term, right? Certainly up to task in terms of their relative rank and performance. So they were in the top decile for the 2020 year, returning 25%. And then finally, if we work our way down, the American Pacific Growth Fund, pretty solid, right? Top decile ranking for the year and pretty heady outright performance. Marathon is the sub-advisor for the Harbor Strategy. A newer manager in the program and kind of running with a little bit more of a value conscious orientation overseas. And we take comfort in the fact that more recently you see here performance starting to stabilize, and I think they'll be just fine longer term and complement the Pacific Growth Fund's orientations pretty nicely. So I think. Yeah, Jeff, to answer the question, those parenthetic numbers are the rank versus peer groups, is how to think of that.
I assume Neuberger Berman and Genesis didn't own a lot of stay-at-home stocks.
No, they didn't. It's interesting you say that. And what really caught them a little off guard, they owned some of it, but not enough of it. And actually their selection in the technology and the healthcare arenas in the quarter was a little bit of a misfire. Again, right, they didn't rank particularly competitive versus their peers. And we've talked about this a million times too, right? We will occasionally see these type of results for a quarter or two. These numbers here are much more impactful and of interest to us, the longer dated numbers. And you certainly see there, right, that you've always been very patient with the managers, as have we, and they've done obviously very good work longer term. So I think they'll
when was Neuberger added to the program?
They've been in the plan almost, I think, Ian, since inception. So I think we've got them coded here back in 2010. So they've been in the plan for close to a decade.
Okay, great.
So that's anything else for folks on?
Do you
on
have
this?
any fee information on these managers and these investments,
We do. Let me see here. We've got
expense ratios?
Yeah, that's fine. There's again, we'll Rick, we can share this right with the group if everyone doesn't have it. Absolutely. Let me just see where we keep that exhibit. Bear with me here. Um, we've changed a little bit of the formatting around, but we should have a summary right back here. Come on, Chris, you can do it. Lots of boring statistics that folks probably don't. Maybe it's at the back, Ian. I'm trying to remember where we capture it in this. With me here. Oh, it's probably right up here. Come on. I don't know where I missed it. We've got a schedule somewhere in this darn report. I used to get that catalogs. Yeah. I will, let me, if it's okay, and I'll report back to the group. I don't know why it's not coming right to me here, but I will get you I'll send to Rick the representation of the portfolio, the underlying managers, and then we blend it together into an aggregate fee for you. The index.
Yeah. Just curious about the underlying fee schedule of the funds, and then is your fee included in the exhibit anywhere? The Mayo
No,
fees?
we do a fee analysis each quarter. It'll actually come next quarter, so it doesn't show in these numbers. It's a flat fee of $25,000 per annum for all of our services, and you'll see that in the exhibit next quarter. The big lift here
Okay.
is right. The investment managers are the bulk of the fees, and those fees are the returns that we show you are net of those manager fees. So
Sure. Yep.
what you see here are all net of those fees. So I will pull that
Yeah.
fee for you, so you've got it, and then we'll go from there. But I don't want to overstay my welcome, but happy to stay as long as folks want me to. But a good quarter and a nice year for the portfolio, and kind of operating, I think, as anticipated. I think we'll take $3.6 million of investment gains every year if we can get it.
Chris, given
Absolutely.
you had shown before the valuation of the U.S. stock market and the international markets, and the interest rates have been moving in the wrong direction for the value of the bonds. There's a few things that are moving in directions that raise my level of concern. Do you have any level of concern as it relates to the investment portfolio here with regard to equity valuations and bond valuations?
Yeah, so I mean, I still think even with the way that rates have creeped up, Jeff, a little bit, right, more recently. I guess today not so much, but in the new year they, as you all know, have moved up a touch. That started to diminish, at least on the margin, right? The kind of dividend yield comparison to treasury yields, and that differential when it starts to tighten up, right? Can suggest different things, bonds relative to fixed income, to equity, excuse me. But I would say this, right? So we still think that all things considered, that on the margin, we think equities are poised to still do pretty well here through the balance of the year. There'll be fits and starts for sure, but there's so much stimulus in the system. We have had pretty resilient corporate earnings. We hopefully have got this vaccination thing getting straightened out, and we do think that creates and carries momentum into 2022, and that all things equal, it should be a decent backdrop for equities. The challenge with fixed income, right, is that 1.25% is kind of tethers to what you can expect from investment grade intermediate maturity bonds for the next couple of years. If you look through time, I don't think we have this exhibit in the book. I'm sure we don't, but I can get it for you. If you look at where you are with the the yield on the aggregate bond index, for example, and you trace that and correlate that to returns, they're remarkably well correlated. So if our starting point this year is about 1.25% for high grade yields, that's probably about what you should expect from fixed income, right? And remember, we have even a more conservative mix in fixed income because we've decided that we, all things equal, we think the return profile for equities is advantageous. And we are up at our maximum in terms of the amount of equity we can put in the program at 50%, but you'll remember that comes with having a very conservative fixed income allocation. So Longfellow is running, as you know, essentially a government and agency portfolio. That's long, but I think we're kind of aware of valuations. I still think that all things equal, equities outpace fixed income moving forward. And I think the way we've kind of got the portfolio set up, equity to fixed income and kind of more over the orientations of the fixed income and how we're leaning into equities. You'll remember we added a little bit of international equity not too long ago, and the valuations there are somewhat more domestic, right? So that was, I think, something that comes to pass in favor of the portfolio if that thesis plays out. So I think all things considered, the portfolio actually is about from our comfort level where we think it should be in terms of the allocation and the way you've got everything sized, and moreover, right, the way the manager's under positioned. So I think we're pretty good.
You think this is a time to be low beta?
I'm sorry?
Do you think this is a time to be low beta?
No, I don't think so, right? Well, I mean, listen, I think year over year, I'm not just forecasting that we're going to mimic the returns that we got in the equity markets last year, but I do think that you want to own that return stream in the fullest expression that you can. I don't think it's time to get cute with that. So I would say, Jeff, no would be the short answer, right? I wouldn't be. If we're in equities, we're in equities, and we want to kind of be fully expressed there, I guess is the way to think of it. Again, up subject to the larger constraints we've got by virtue of the state statute, that limits us to 50% of the total.
Yeah, I was just going to ask about that, Chris, and I'm sorry, I'm relatively new. Is the asset allocation decision a town decision, a state decision, or a DeMayo decision?
Yeah, so the way it works, Ian, is that this fund is subject to a state statute that has some limitations on the way the portfolio can be allocated. If you read through the statute, what it says is for funds like this that have an investment policy statement, which of course you do, you can invest up to 50% of the portfolio in equity you're choosing. If you do that, then your fixed income has to look like this. And that's why I said earlier, right, it has to be pretty dialed down and in very conservative liquid instruments, which your Longfellow and your TIPS assignment with Vanguard are. So our allocation here is a byproduct of that state statute. And then where we're looking to tease out returns over time, as you can appreciate, is where there are active bets in the portfolio with active managers. Longfellow to an extent, but probably more greater potential for sure with your active equity managers. That's where we're trying to tease out some of that incremental return. So the allocation you saw 50-50 is a byproduct of us being in agreement with, if you will, with the state statute.
Got it. Okay, that makes sense. Thank you.
So if you wanted to go more towards emerging market bonds, you got to pull back in essence on the equity side.
That's right, Jeff. Yep, that's exactly right. So we could, if we wanted to get more aggressive with the fixed income expression, we'd have to dial back the equities. That's exactly right. And again, right, I think all things equal, I think we kind of lean into equities right now still vis-a-vis fixed income. So just in terms of, the potential for absolute return being better there. It's really driving me crazy now because I know we have, well, I'm not going to take the committee's time. I will get that fee exhibit for you and highlight it for Rick and we'll get it out to the group. I'm going to stop sharing just so if that's okay for folks and see what other questions the group may have.
See, Rick has joined us.
It took 45 minutes to figure it out, but I had moved WebEx onto my laptop as well last week. I'm using my iPad here right now, and I changed my password and forgot that I had done that. So sorry about that.
That'll do it. No worries.
But I will. Chris will get us that report, and we'll get it out to you. With the fees on there as well this week.
Okay.
Anything else for Chris?
I don't want to take up too much time, but I'm not that familiar with Longfellow. Is that a intermediate bond mandate? And then is it, you said it was tilted towards government. Is that by mandate or by their, the state mandate? Or?
Yeah, it's the intermediate government and agency paper, and it's separately managed, right? So as opposed to the institutional mutual funds that we use elsewhere in the program, this is actually a separate account. The fund physically owns those bonds via the Longfellow arrangement. And again, right, the edict there is dictated, or the mandate and its orientations for Longfellow are dictated by the equity profile you have today. So they've been given the mandate to run, a very conservative, liquid, intermediate duration paper portfolio. They certainly have the wherewithal and capability to do corporate bonds and the like. But again, we've dialed them down there because we like the equity profile better and want to try to take advantage of that. So, but yes, to answer your question, it's Longfellow could turn that portfolio into cash in 2 days if they needed to.
Okay, and that was a DeMayo decision, or to go with the more conservative bond fund?
No, that's again a statute. Yeah, that's the statute.
Okay.
Because we're fully out to the most we can be in equities at 50%, and that dictates the type of fixed income you can do.
Wow, that's crazy. Okay, good to know. Thank you.
Yep. Jeff, I don't hear anything else, but those are all great questions and appreciate the input from everyone. And at your direction, I will exit.
Any other questions or comments for Chris? If
No,
not,
thank you, Chris. Oh, sorry. One more quick question. The merger of DeMayo and FIA. How many people have left here at the FIA office? There's quite a few new people. Is that old Chicago, or is FIA here growing or staying equal, or going smaller?
No, great question. It's a little bit of both. We've got people hired into both offices. Our two main offices are Chicago and Windsor, up near the airport. We haven't laid off anyone. We've had a handful of people retire in a planned basis, but everything else has been net hire. And those folks you see on that page are kind of an equal mix of Chicago and Windsor in terms of the ads.
Okay, great. Thank you.
anything else for Chris? If not, Chris, thank you very much. May the Bears stay away and the Bulls keep on running.
I would wholeheartedly agree with that. Well, again, good evening, folks, and thanks for your time and good questions today, and we'll be following up.
Okay, very good. Thank you.
Thanks,
Bye.
Chris.
Thank you, Chris.
There's nothing on the agenda about other business. Is there any other business? Any other issues to bring up? Any new news on UConn? Rick?
No, nothing new there that I'm aware of anyways. I did look into that after our last meeting, and at that point, there was nothing new. And as far as I know, there's been nothing new since that meeting.
Okay. So they're just trying to look for a new buyer, right, of that property?
They are, yeah.
Yeah.
But I hear, I'm hearing there's interest from multiple parties,
Okay.
but that's outside of that. I don't know anything more.
Yeah.
Any other business outside of hoping that Verst House opens this month?
Can we have a meeting at the worst house maybe as a?
Let's all get our vaccines and yeah, let's meet there.
Yeah, right.
Well, we're going to be eating outdoors in another month, so.
Yeah.
We actually were in Mystic on Friday and had outside for lunch. It was beautiful. Heaters
Yeah,
helped.
if you pick a good day, you can do it.
Wednesday, 49 degrees.
Yeah.
It's good enough.
Yeah, that'll do it.
Any other business and any other issues to bring up? If not, is there a motion to adjourn?
I move we adjourn.
Second?
Second.
All in favor? Anybody against? If not, it's cocktail hour. We'll see you next month.
All right.
Thanks, everyone.
All right.
Thank
Thanks,
you.
Jeff.
All right, bye.
Bye.